Hello everybody, and welcome to Module 3 of the 3 Pillars, Session 2, the income statement. As the title says, we're going to go through a lot of the income statement today, and we're going to go through all the items that either make up revenue, that make up your cost, how to analyze your cost, and how to analyze your statements in general. So we're going to go through quite a bit of information on this particular session, so let's go ahead and begin. In this session, we're going to review revenue recognition. I know that sounds kind of stale, but that's very important that we go through and understand the revenue, how and when you recognize revenue. Cost of goods sold or cost of sales. I'm going to go through the gross profit and gross margin, variable versus fixed cost, operating expenses, break even, key one there, regardless of what you do. We need to figure out how to help you calculate your break even, your EBITDA. That's a fancy little way of saying earnings before interest, depreciation, tax, and amortization, and your net income. And of course, we're going to go through the ratios for your sales margin, your net income as a percent of revenue, and why those are important and how to identify the importance of those. So the income statement. Now, as we discussed earlier in our earlier module, the income statement can go by the following names: the income statement, profit and loss, P&L, statement of operations, and statement of income and owner's equity. Now remember when we went through the templates on the previous module where I showed you the income statement, we scrolled down and we saw the equity part on there. That's what this last statement, the statement of income and owner's equity, it's common to have those two items combined into one statement. So it's not uncommon to see that, so just keep in mind if you do come across that particular situation. Now, revenue. When to recognize. So what we call the old rules was when was it earned and when was it realizable. So when did you provide the service and when is it realizable that it is going to be a true sale or a true revenue procedure. So always kind of keep that in mind, is when did I earn that? And that's why a lot of times people don't realize they could have earned the revenue and they would have a receivable. They might not have billed for it yet, but they do have a receivable, so they have earned for the revenue. Now, new for 2019 is the accounting rules, and maybe take a step back. So we're talking the whole time in these modules, we've been talking about GAAP, Generally Accepted Accounting Principles. Now, the organization that promulgates GAAP is called FASB, the Financial Accounting Standards Board, and FASB determines what rules you should use for GAAP. So in early, I'd say about 2014, FASB came out with rules that would change how revenue was going to be recognized, and this was supposed to streamline and make revenue recognition consistent across all industries. And this policy is now in place for 2019. So the accounting rules require you to recognize revenue in this certain way, and there's a 5-step process. For right now, I don't want you to worry about that. If you're going to get an audit of your financial statements, then let's discuss the new procedures. It's really not that different from what you're going to be doing now. I just don't want to confuse you. I want you to think of the simple, is it realizable, realizable, and has it been earned, that respective revenue. I want you to keep that in your mind. If you have to get an audit or somehow submit it to some sort of agency, then we can talk about the 5 steps in the new revenue recognition procedures. They pretty much, in a nutshell, go through all the same steps. They just break it down differently, and you have to have a set policy in place. But again, I'm not going to have you try to implement something like this right now, unless, of course, you're going to get a financial statement audit done. Now, sales return. This is a contra to your sales account, and you need to break it out on the income statement. So if you ship a product and somebody returns it, you have to negate that sale, and so you hit a second account. You don't hit your revenue account, you hit a sales return account, because you're going to put it back into inventory. And when you do that, it's a debit account, and so it's a contra to your sales account. And it's important that that gets broken out, and normally you have that segregated on your income statement. Now, if it's immaterial, like we discussed back in Module 2 when we went through the templates, if it's a small, teeny tiny amount, don't break it out on your actual statements. But if it is material, then go ahead and start doing the breakout on that. Now, the big item within this is cost of goods sold. Regardless of what you do, whether you sell a product or you have a service, you're going to have costs associated with generating those revenues, because there's no business out there that you get 100% revenue and have absolutely no cost. I mean, even if you are an author of a book, you know, when you're writing that book and you're getting it copyrighted and proofed and the cover and all that stuff, that's still cost, even though once you get it up for sale, you know, the sales, the costs that you're going to have are going to be sales costs. You still have a cost to produce that revenue. So no matter what you do, you have costs associated with that. And these are the costs you so much want to identify and figure out what they are. I mean, you want to drill down as far as you possibly can on these respective costs. Now, cost of goods sold is sometimes referred to cost of sales. And like we've said before, it's made up of direct materials if you're selling a product, direct labor, both selling a product and a service. So if you're doing a service and you're doing an IT service company, you may have IT people working with you, and when you send them out in the field, you know, they're producing revenue for you, but their salary is a direct labor cost, and that's part of your cost of sales. So, and also on production for manufacturing, that person who's assembling the widget, assembling that product, their labor hours are directly related to that widget. So that's part of the cost of sales. And then, of course, overhead. Now, these again are the costs that are happen or necessary to keep the operation running, but you can't specifically identify them to relate directly to a product, so they're considered overhead, and you allocate based on a percentage. Now, many of these costs are going to be accounted for in the inventory. So, as you remember when we went through the inventory section, you know, we talked about the value and the process of allocating costs. All the costs associated with producing a product is going to be put into the inventory cost. So when you determine what your direct labor is, what your direct materials are, what your overhead allocation is, all that cost goes into the inventory number. And from there, it only hits your cost of goods sold when you sell the product. So think about this as if I produce one widget and my direct labor was $1, my direct materials was $1, and let's just say my overhead was 50 cents. So I have $2.50 or $2.50 to produce that one widget. Well, my accounting entry is to put that into inventory until I sell it. When I sell it, then I release it out of inventory, so I reduce inventory to zero. And then the other side is to move it over into cost of goods sold. So that's why it's important you understand is whatever you make, all your costs are going to be up in the inventory, and they don't hit your cost of goods sold until you sell that product. And that goes back to the concept that we discussed in the previous session of full absorption costing. All the costs related to that product need to be absorbed and put into the product so you get an accurate cost of goods sold. Gross profit and gross margin. Now, gross profit, again, this is just the difference between your sales and your cost of goods sold. You know, sales minus cost of goods sold equal your gross profit. Your gross margin will represent a percentage of your gross profit to your sales. So again, gross profit to sales equals your gross margin percentage. And this is extremely valuable to understand this percentage, as you can compare this to competitors. Again, this is just another key for you to be able to see, okay, my gross margin's 15%. What's my competitors? If my competitors are a lot higher than me, what does that say? Well, maybe that means, you know, I'm selling too low, or my costs are too high. I'm buying from the wrong supplier. Again, this is a valuable tool to be able to compare to your competitors to see, am I in line? Am I above them? Am I below them? You know, what do I need to consider, you know, as I'm going through that particular revenue cycle. Costs, variable and fixed. Now, when you're determining your break-even point, it is extremely important that you understand what your variable costs are and what your fixed costs are. And these two main categories, variable and fixed. In a nutshell, variable costs will go up when your sales go up and will go down when your sales go down. So in other words, if you're selling a product and it requires insulation, and depending on how much, let's say one panel of insulation is what you sell and is part of the overall product. And when you go through and you buy more panels because you have more sales, well, you have more costs. But the less sales you have, the less costs, less inventory you're releasing to cost of sales. So that's what variable is the more sales you have, the more cost you have. The less sales you have, the less cost you have. So that's the overall concept on variable. Fixed costs are costs that are going to happen regardless of if you have $1 of sales or $1 million sales or 100,000 of sales or no sales. Fixed costs happen. So the easiest item to consider on fixed cost is rent. So your rent for your building is going to happen whether you make any kind of products or you sell a bazillion products. You still have to pay that rent. And in fact, you'll have to pay rent even if you decide to not even work for a month and go out on a Disney cruise or something. You're still having to pay. That's a fixed cost that will always happen regardless of the level of sales. And it's, again, this is key for when we're looking at our break-even point, is because we want to know what are variable, what are fixed. Because when we get to the break-even calculation, you'll understand is how that flows through and how that can be adjusted. Because the fixed costs, you're going to have to cover those regardless. So if you have $5,000 in rent, let's say your fixed costs are $5,000, right away I have to cover $5,000 or make $5,000 just to cover my fixed cost alone. And again, this will also help you determine the minimum sales price. You need to make sure that you understand these costs, because I've seen it before where somebody had a really low sales price and they were all happy because they had a whole bunch of sales, but as the months and years went on, they were losing money. Well, it's because they had too low of a sales price. They were more or less giving the product away. So remember, we're doing this because we want to grow your money. And to grow your money, we need to understand the roots of all that goes into this. So let's keep that in mind as you're going through this. Again, there's a lot of concepts getting thrown at you, but I want you to understand the overall goal for this is to make sure that you're growing your money, and eventually your company will be working for you, not you working for your company. Now, operating in general. Historically, if the costs cannot be directly linked to a cost of goods sold, then they go into either operating or general and administrative. Now, it's an important part of the breakout is to understand what costs affect your productivity indirectly. So again, if you think about you're renting a huge warehouse and maybe a quarter of the warehouse is being used for production, the other part is not. Well, if you're paying $10,000 a month rent, you need to figure out how much of that rent should be allocated to the production part. So again, that's why it's important to understand what your operating costs are and have them broken out. And then maintain a vertical analysis of the costs. So let's go into the templates that we have for the financial statements for Module 2, and I'll show you what a vertical analysis is. So here is the income statement from our core statements, and I just did a copy over here so it didn't get confused with the other income statements. And I just want to drop in these percentages so you can see what a vertical analysis is. So you see these percentages off to the side? What I've done is I've just said, okay, of this selling expense, how much of that is total expense? Of this labor expense, how much of that is total expenses? So we go down vertically on each one of these, and you do it for 2 years. Now you want to have it for 2 years or 2 periods because you need to be able to see trends. Just doing 1 year is not going to tell you a whole lot of information. 2 years will tell you a lot more. So as you can see, selling expense has, the past 2 years been about 2% of total expenses. Labor, looks like labor jumped up, was 34%, now it's 53%. Rent, even though rent dollars have stayed the same from the last year to this year, it as a percent has gone down. That's obviously primarily driven by you have more labor expense. Because you have more labor, you had more revenue because you needed more people to work on the projects. So that's how this tool can be used, is you can go through and quickly analyze any kind of fluctuations, because from here to here, 9,000, 9,000, it doesn't seem any different, but because our total expenses went up as a percent, that changed. And so that allows you to be able to analyze your financial statements really quickly to see any categories that get out of flux. Now, this is a valuable tool if you have somebody who accidentally posts a journal entry in the wrong spot, or if you just seem to have more expenses, let's say like supply expenses, than normal. You may look at it dollar to dollar last year to this year, and it may seem okay, but as a percent it may have gone up dramatically, and that gives you an idea. Okay, why would that go up as a percent of expenses? Or if you just have a weird flux when you're not expecting, let's just say if we didn't know the dollar reasons for this increase, you may say, okay, why did my labor go up to 53% of total expenses when it was 34 expenses? As you start to get more experience in your business, and more activity, and you kind of get consistent on that, these percentages will level off, and you'll immediately be able to identify. In this situation, this is a new company that's growing, so these are going to get us skewed. But if you have a company that's been around for 3-4 years, these percentages start to become consistent, and you can quickly identify any discrepancies in there, and or maybe you're using too much for an expense that you probably shouldn't have. So that is what a vertical analysis looks like. And now we're up to EBITDA, earnings before interest, depreciation, tax, and amortization. Now, EBITDA is one of those things that the bank will look at when they look at your financials. So when you're applying for a loan, or you're applying for a line of credit, what have you, they're going to look at your EBITDA. And EBITDA is one of those metrics that the way it's designed is it's kind of a quick, down and dirty way to see how much cash are you producing in your company. So if you think about it, interest, while it is an expense, it's usually attached to a loan. Depreciation is a non-cash item. Taxes is, again, that's not an operational expense. And amortization is like depreciation. It's not an operational expense. So those are the big items that, one, they affect your net income. And if you think about all of those items, they actually reduce your net income. So the bank wants to see what's your net income from just operations, and in a way it also is a rudimentary way to identify what the cash flow is from your company when they take out the non-cash, non-financing type items. So that's why EBITDA is important. You will hear that term a lot, so make sure you're familiar with that, especially if you're going to be applying for a bank loan. Again, you can do this calculation on your financials. Just go down to the bottom of your net income statement and then start backing out the interest, depreciation, taxes, and amortization, and then whatever that number is, that's what the bank will be looking at. So before you go for a bank loan, do this calculation yourself so you have an idea. Again, we want to put the power back into your hands for when you're going to the bank. You have an idea of what your EBITDA is, so that if the bank's waffling on whether they're going to give you a loan, you have another negotiating point. Assuming your EBITDA is a fairly good number, you have a way to say, well, my EBITDA is X situation. So that could help you in your negotiations with the bank. Net income. Now we're to the big one that we all like to see. Obviously, net income is the total of your revenue that you have left after all your expenses have been accounted for. Now remember, we're talking about accrual accounting. So if you incurred something, you have to have it recorded, or if you earned something, you should have it recorded. So net income gets it down to what truly have you made in this company. And as a small company, sometimes you want to calculate net income and add back your owner's compensation. So if you're paying yourself a salary, usually you want to add that back to your net income number when you're comparing to your competitors. Now don't do this when you're sending it to the bank. This is strictly for you to be able to analyze how do you stack up to your competitors. So that's one of the things you want to keep in mind in that process. Now, sales margin. Okay, we're going to bring up this template and we're going to go through. This is a very valuable measure to determine the profitability of a product or service, and particularly for products and services that are customized to some degree. So this calculation we're going to go over, you really want to do it. You can do it on an overall sales standpoint, but it's more beneficial to do it on an individual product standpoint, because you may be, having, fairly good net income, but until you break down your actual products to find out which one's really the one driving it, which one's not, it's going to be difficult. So that's why you want to do the sales margin. So let's go ahead and jump into the template on the sales margin. So here's the template, and as you can see, there's two items on here, and we'll go over both these. And this net income to sales, we'll go over that. That's another slide that's coming up, but we'll hit that, seeing how we're right here to begin with. So sales margin. Again, here is just overall sales. This isn't an individual product. These numbers I have here are in total, just so you can see how the formula works. But as you can see, here's our sales, here's our cost of goods sold, here's our gross profit, and then our selling expenses. Now, your selling expenses are all the expenses that are related to that particular product. So if you have salespeople who are getting commissions by selling product X, that's going to be part of your selling expense. Any sales salaries if you're not paying commissions, any benefits to the salespeople, customer service related to that product, the travel for the salespeople for that. So anything expense-wise that is incurred to sell the product, that's what you want to bring into this as selling expenses. And so then comes down, and this is just a generic net income number. But what the sales margin does is it goes from your gross profit margin. If you recall, gross profit is literally your sales minus your cost of goods sold, and then brings in the element of the sales expense. So then what it's doing is it's giving you a total margin on that product. So the formula is it's going to take your gross profit less your sales expense. That net number will then be divided by your sales. And in this case, this particular situation, this came out to 17.2. Again, this is something you want to do on your individual product level, because once you understand what's the margin on each of my products, you can then focus more or less resources to a specific product. Because you may have a whole bunch of sales, let's say a whole bunch of sales on a particular product, but if it costs you more on the cost of goods sold side and the selling expense side, it might not be worth all those additional sales numbers. Because remember, while this number is at the top, ultimately we're more concerned about how much are you bringing home after the expenses. So that's what the sales margin is valuable for. Is you run it based on your product, and even if you're a service organization, you run it based on whatever service you perform. If you're a lawn maintenance company, you may have one service is just doing the standard mowing every week. Another service may be ripping up the irrigation pipe and putting them in, or another service may be blowing out the sprinklers in the wintertime. Different services. So you want to understand, where's my sales margin? And you may have a product or service that just is costing you money, and it's not worth your time and effort to pursue that. Or conversely, you need to increase your rates or your cost of that product to make it worth your time. Another item on here is net income to sales. So as it says, it's a pretty simplistic formula. You take your net income and you divide it into your sales. For a small company to really manage your company well, you want that number to be at least 10% or higher. If you're less than 5%, your company is going to, at 5% or less, your company is going to have a lot of difficulty staying afloat and, making it worth your time to go through that process. And again, that's when you take a step back, and if you're at that level, is do I need to cut my costs? Do I need to increase my rates? Again, this is one of those drivers for your levers on your company. Again, we want to make that, ideally we want to get you to 10%. So how do we get you to 10%? We can increase your sales costs, or your sales price of your products. we could see about reducing expenses going through there. There's different levers that we can pull to get you to that. And that's one of the things I do in my virtual CFO service that I provide is I work with my clients and I go through their respective levers. And I show them if you add this $1 more to your sales product, this is where you're going to wind up. Or if you reduce this the salaries by this amount, or reduce one individual from your sales, here's what's going to affect. And so those are all the levers in there to ultimately get them to 10% or higher. But like I said, if you're at 5% or lower, absent, obviously if you're a first year client, or a first year organization, just take that with a grain of salt because you don't have enough experience yet. But if you're past that first year and you're at 5% or lower, you need to take a step back and analyze your company, because if you don't, you're going to wind up with probably no company within a couple of years, because you won't be able, it'll be too difficult to recover. So that's what I wanted to go over on these templates. And like we just said on the template, net income as a percent of revenue. Net income, as we said, should be a revenue at 10% or higher. Pretty much all the literature nowadays is saying if your net income is 10%, that's technically what they consider the new break-even point, as just a percentage. And again, that's just a generic statement, but that's really what people are seeing on the health of a business, is 10% is really the new break-even point. So speaking of break-even, let's go into this. Now, no matter what you provide, whether it's a product or service, you have to know what your break-even point is. If you don't know what your break-even point is, it's going to be very difficult to be a successful business. The break-even point can be done at a product level or at a company level. Now, I highly recommend you do it at a product level. Do it at a company level as a general, okay, here are all my expenses, here's the total sales I need. But you want to also break it down to the product level, because it gives you an idea. Again, it goes back to, am I selling this for enough? Yes, I'm getting sales, but sometimes, as we sometimes say, is if you're getting a ton of sales in, maybe your sales price is actually too low. Maybe it should be higher up. You're going to have to play with that part. But several variations exist on break-even. You'll hear that throughout different literature on the break-even point. Some take a variable cost against the sales price, and then they reduce it by the fixed assets. However, or I mean not the fixed costs. However, the most simplistic way is you literally take your total operating expense and you divide it by your average gross margin percentage. So let's go ahead and take a look at the formula so I can show you with numbers. But again, this is a very simplistic way to do it, and it makes it a lot easier. There is more detailed ways. If you want to get into cost accounting, I will have a future webinar on that where we'll go through the actual dive deep into cost accounting, because cost accounting is in of itself a whole genre of accounting practice. So let's go ahead and go into the template. So here we are at the core financial statements. This is the template that we went over in Module 2. And from here, I'm going to use these actual financials that we've gone on previously and show you how the break-even analysis works with these numbers, so you can kind of see how it flows through. So I started the screen on the income statement, and that's because obviously we're wanting to know what the break-even is in our revenue. So I wanted you to see, here's the income statement that we've gone over a couple times, and you see over here, here's this tab for break-even. And what I've done is I've brought in the formulas for the break-even. So remember on the slide, let's go back to that real quick. So remember, our formula is total operating expenses divided by the average gross margin percentage. So let's go back to the template real quick and we'll see how that formula translates. So you'll see on here, total operating expenses, $65,000. And what I've done is I've linked all this information from the income statement tab. So when you look at this, if you look up here in this toolbar, you'll see every single one of these items has a link or a formula. So all this is going to calculate automatically. And I have this note here. If you happen to be looking at this template and you're still in Module 2, you're not quite sure what this is, I put that there just as a note, just in case. But on here, so this 65,000, so come over here and we can see this 65,000 expenses. That links over here. Then remember, the formula is operating expenses divided by your average gross margin percentage. So the average is going to be your 2 years or your 2 periods. Normally you want to do 2 years because that gives you an idea as to truly what your break even is, because your gross margin will be really where it needs to be. If you try to do it on a monthly basis, you're going to get some skews, because you might have 1 month where your gross margin is high, 1 month where gross margin is too low, and it's just going to skew your break even. So that's why you want to try to use these on historical end of the year numbers to be able to drive your future break even analysis. So here we go. Here's our revenue, 348. 600, and I took the net, so I netted out the discounts, because sometimes you won't have these numbers broken out, you just have them netted in there. So I just said, okay, let's just take the net sales number. Same thing here from the prior year. Here's our gross profit. Come back over here. There's our gross profit. There's our gross profit. So I'll come back over here and let's zoom in real quick, and you'll see here is the calculation of the gross margin percent. 27.58 for this year, 31.03 for the prior year. So the average of those two comes out to 29.31. And so the break even, what this is saying, this is taking our operating expenses divided by the gross margin percent to get to our break even, which this is how much revenue we need to make to break even for this company. Now, the reason why this formula works is because if you're wondering, well, we only bring in 65,000 costs, we've already netted in this number, this gross profit, we've already netted all the cost of goods sold in there. So that's already actually being taken care of in our formula. So what this does is this says, okay, here's what we have after cost of sales, and the average amount is going to be 29.31. And then here's all the expenses that don't hit your gross margin percent that we're going to need to cover to break even. So that's how this formula works. So this number right here, this 224,332, is the total revenue in the current year that you'll need to make to break even for this company. So let's prove this formula. So 224,332. So let's come back over here, and I'm going to override these cells in here. So after I override, these numbers will start changing. But let's just remember this number, 29.31. and 224,332. So let's come over here and put in our revenue, 224,332. Again, I'm overriding some of these cells in here, so I don't do this unless you just want to prove it, but make sure you don't save because it'll mess up the flow through. Now, remember 29.31 was our percent. So what we do is on this cost of goods sold is we say, okay, we know this number, we want it to be 29.32. So we do the mathematical equation here and say, okay, our cost of goods sold then has to be the inverse of the 29.31. So that says this number times, and if you look up here in the formula, so you'll see the formulas I'm putting in as well, times 1 minus 0.2931. Because remember, if this number has to be 29.31, that means this is going to be the 70-some percent, and so that's why I'm taking 1 minus that. You can also do the calculation off to the side, but I'm just doing it here so it'll flow through quickly. So that drops in, and then you come down here, and this net income isn't exactly zero because these items are not accounted for in the respective break-even analysis. So that's why this is approximately this amount. There's also some rounding in there because we're using percentages up here. But this gives you an idea as to, okay, to break even, this actually proves the formula. I need to have, for this company, at least 224,000 in net income, or I'm sorry, 224,000 in sales, net sales. My cost of goods sold is going to remain at the percent, gross margin percent that we calculated, and so that comes down to getting us to break even before all the miscellaneous stuff that you don't want to bring into your calc. The reason why you don't want to bring this into your calc is because it can skew like miscellaneous expenses. That can be, this year it can be $500, next year it can be $3. You don't know what that's going to be, and it's just one of those oddball things. So that, in a nutshell, is the break even. And like I said, this is a very valuable tool to do on a product level. So if your accounting system, so when you're selling products, you want to get your accounting system to a point where your sales and your cost of sales by product, you need to get that broken down. This, keep in mind, this is just the overall company. But if you break it down by a product sale, you will be so much more profitable, and you'll be able to navigate all the pitfalls of the economy going up and down, and competitors coming in, and all that stuff. You're going to be able to navigate that so much better because you're going to have valuable tools in your arsenal. Again, think about it this way. If you had a competitor come in and you have product A, B, and C, and all of a sudden they're coming in and they're doing what some competitors do. They cost cut, and they're trying to undercut you on that. If you know what your gross margin is, your break-even point is on products A, B, and C, and you're willing to say, okay, on product B and C, I can take a cut on the sales to get it to break even, because I know that'll drive that competitor out of business. Or conversely, you can also say, I produce a superior product, so I'm not going to cut that. But you at least have that ability to identify what's my break-even point on all my products, and do I need to take a gamble on one particular product to reduce it to maybe increase sales, do a sale discount, or something of that nature. So again, very valuable tool, and you need to know what your break-even is, regardless of whether you sell products or do services. You need to know what that number is, because if you don't know what that number is, you don't know how to direct your company to where you want it to be in the end. So that concludes session 2 on module 3 on the income statement. Please continue on to session 3, where we're going to go through the cash flow statement one more time. Thank you.